The price of silver, at first glance, seems like a simple reflection of supply and demand, how much silver is mined and how much is consumed by industries and investors. But if you stop there, you miss the deeper, more powerful forces that truly drive its value. Silver, like all assets, moves within the larger ecosystem of the economy, shaped by credit cycles, monetary policy, inflation expectations, and human behavior. Understanding this web of connections is what separates the average speculator from the thoughtful investor. Let's begin with the basic truth about money. It's a human invention built on trust. Currencies gain and lose value based on that trust, not on their physical substance, but on the credibility of the institutions that issue them. When central banks print money aggressively, they're essentially expanding credit in the system. That can stimulate growth in the short term, but over time it erodes purchasing power. Silver and other real assets serve as a counterbalance, a store of value that doesn't rely on promises or paper confidence. Throughout history, every time governments faced debt crises or fiscal imbalances, they turned to monetary expansion, printing money, lowering interest rates, or devaluing currencies. From the Roman Empire debasing its coins to the 1970s stagflation in the U.S. to the massive liquidity injections of 2020-2022, the pattern repeats. And each time, silver responded. It surged when paper assets lost reliability because human psychology seeks safety and tangibility when uncertainty rises. If we study the long-term cycles, we see that silver's behavior is tightly linked to what Ray Dalio calls the big debt cycle. It starts with periods of productivity and growth, followed by credit expansion. Borrowing increases, optimism grows, and asset prices rise. Eventually, debt burdens become unsustainable. Then, policymakers face a choice: allow painful deflation or print more money to inflate their way out. Most choose the latter. And that's when real assets like silver rise sharply as the purchasing power of currency declines. Right now, the global economy stands near the late stages of such a cycle. Debt levels, sovereign, corporate, and personal, are historically high. Many developed countries have debt to GDP ratios exceeding 100%, and interest payments alone are consuming a growing share of budgets. To manage this, central banks eventually must lower real interest rates, often below the rate of inflation. That's called financial repression, and it's one of the strongest tailwinds for precious metals. Silver, however, plays a unique dual role. It's not only a monetary metal like gold, but also an industrial one. It's essential in solar panels, electric vehicles, electronics, and even medical technology. This means that even as it benefits from monetary instability, it also gains from technological transformation. When investors overlook silver, it's often because they view it through a single lens, either as an inflation hedge or as a commodity. But its real power lies in its position at the crossroads of both narratives. Consider what's happening with global energy transition policies. Governments worldwide are pushing for clean energy, and solar energy is at the heart of that shift. Silver is an irreplaceable component of photovoltaic cells, and demand from this sector is projected to rise substantially over the next decade. Yet silver supply growth remains limited. Most silver isn't mined independently. It's produced as a byproduct of other metals like copper, lead, and zinc. That means silver output doesn't easily adjust to higher demand. It's constrained by the economics of those other industries. When you have rising demand and constrained supply, prices eventually must rebalance upward. Now, let's layer on the psychological and behavioral dimensions. Markets are driven by collective emotions, fear and greed, amplified by cycles of confidence. When investors feel secure, they favor growth stocks, leverage, and paper assets. When uncertainty rises, Due to inflation, geopolitical risk, or credit stress, they move toward hard assets. But this shift doesn't happen overnight. It builds quietly, then unfolds rapidly. By the time the crowd realizes what's happening, the big gains are already behind us. That's why the thoughtful investor studies these dynamics early and acts with foresight rather than reaction. In many ways, silver today resembles an overlooked chapter in a larger economic story. People focus on short-term news, inflation readings, Fed announcements, and GDP numbers, while missing the structural forces shaping the next decade. History teaches that when real interest rates turn negative for extended periods, silver tends to outperform most asset classes. During the 1970s, for instance, silver rose from around 1.50 to nearly $50. Inflation eroded the value of money, and investors sought safety. After the 2008 crisis, amid quantitative easing and low rates, silver again soared, peaking near $50 in 2011. These are not coincidences. They are cause and effect relationships. When money supply expands faster than productivity, currencies devalue relative to real assets. When confidence in monetary policy weakens, investors hedge with tangible stores of value. These forces are structural. They repeat because the human system that creates them doesn't change. Another layer to understand is leverage. In modern financial markets, leverage amplifies both gains and losses. When liquidity is abundant, speculation pushes asset prices higher, often detaching them from fundamentals. But when liquidity tightens, leverage positions unwind, creating temporary price drops in assets like silver. Even when fundamentals are strong, these short-term drops often create the best long-term opportunities. Smart investors recognize that volatility is not risk, it's the price of entry into undervalued assets. To think in the way Ray Dalio often describes, one must move beyond what is happening to why it's happening. The why reveals the mechanics, and mechanics don't lie. Right now, central banks are trapped between inflation and debt. They can't raise rates too high without destabilizing the system, and they can't print endlessly without further devaluing currencies. This balance creates fertile ground for hard assets. Silver, being cheaper and more accessible than gold, tends to attract a broader wave of investors once momentum begins. The deeper truth here is philosophical as much as financial. Societies rotate between trusting paper and trusting reality. Every generation eventually rediscovers that money, when overproduced, loses meaning, and that value anchored in something scarce, useful, and tangible endures. Silver represents that reality. So when we talk about silver's price in 2025, we shouldn't focus on numbers alone. Whether it's 35 or 50 or higher is secondary. What matters is the understanding that its movement reflects a deeper recalibration, a shift in global trust, a response to excessive credit, and a return to tangible value. The investor who understands this doesn't need to chase predictions. They simply need to recognize the pattern, the same pattern that has repeated for centuries, and prepare accordingly. Silver's story is not about speculation. It's about preservation, discipline, and understanding the timeless rhythm of economics and human behavior. Every market, every asset, and every economy operates within cycles, long-term and short-term. These cycles are driven by forces that repeat throughout history because human behavior is consistent. People are motivated by fear and greed, optimism and pessimism, and these emotions create the waves that move prices up and down. The same applies to silver. Its current undervaluation isn't random. It's a stage in a much larger economic rhythm that's been repeating for centuries. When we understand the mechanics of these cycles, we stop reacting emotionally to market moves and start seeing them as opportunities created by time and psychology. Silver's price doesn't just fluctuate based on mining output. or industrial demand. It's influenced by liquidity, interest rates, inflation expectations, and confidence in the financial system. In short-term cycles, prices respond to immediate events, central bank meetings, inflation data, geopolitical shocks. But in long-term cycles, prices move according to structural forces, debt accumulation, monetary debasement, and shifting global power. When we zoom out, silver's undervaluation today mirrors similar moments from past decades when the world was transitioning from one monetary environment to another. The simplest way to see this is by looking at the gold to silver ratio, the amount of silver it takes to buy 1 ounce of gold. For centuries, this ratio hovered around 41:1. When it rises above 81:1, it indicates that silver is historically cheap relative to gold. Right now, the ratio is hovering near or above 85, signaling a deep undervaluation. Each time this happened in the past, in the early 2000s, in the late 1970s, and briefly after the 2008 crisis, silver eventually surged as the ratio corrected toward its historical norm. This correction doesn't happen quietly. It happens suddenly when investors collectively realize that an imbalance has gone too far. To understand why, we must look at how monetary policy creates these imbalances. When central banks lower interest rates and increase the money supply, they stimulate borrowing and spending. Asset prices rise, but the benefits are unevenly distributed. Financial assets, stocks, bonds, and real estate inflate faster than commodities or real goods. This leads to a temporary illusion of stability. Eventually, however, the underlying value of money weakens, and investors begin searching for assets that hold purchasing power. That's when real assets, like silver, begin their ascent. Silver's undervaluation today is a product of this cycle. Over the past decade, central banks injected trillions into the global economy, expanding their balance sheets to record levels. That liquidity inflated equity markets and government debt, creating one of the largest wealth bubbles in history. Meanwhile, hard assets lagged behind as capital chased digital and paper-based returns. But just as in previous cycles, what's undervalued now becomes overvalued later, and vice versa. Silver's time in the spotlight comes after a long period of neglect, a phase that always precedes explosive revaluations. Cycles, at their core, are governed by cause and effect. When debt rises faster than income, when money is printed faster than productivity grows, and when confidence in institutions begins to erode, the pendulum swings back toward tangible stores of value. The silver market, though smaller and more volatile than gold, responds more dramatically to these shifts. Because it's thinner in volume, smaller capital flows can create larger percentage moves. That's why when the tide turns, silver doesn't rise slowly. It accelerates sharply. We've seen this behavior repeatedly throughout modern history. In the late 1970s, inflation soared after years of monetary expansion and oil shocks. Silver, which had been languishing below $2 an ounce earlier in the decade, skyrocketed to nearly a fifth dollar as investors sought protection from inflation and currency weakness. The same pattern emerged after the 2008 financial crisis. Following the Federal Reserve's quantitative easing programs, silver rose from under 10 in 2008 to around 50 by 2011. In both cases, silver started from a deeply undervalued base and corrected violently once the imbalance became evident to the public. The reason most investors miss these turning points is that they're anchored in the present. Human nature favors linear thinking, assuming tomorrow will look like today. But economic cycles are nonlinear. They bend and reverse when forces become extreme. Silver's undervaluation today reflects one such extreme. The world has gone through years of asset inflation in stocks and bonds, fueled by easy money. Yet that era is nearing its natural limit. As debt service costs inflation and geopolitical fragmentation put stress on the system. Historically, these pressures mark the early stage of a commodity revaluation cycle. Another layer to this is behavioral. When an asset underperforms for a long period, it falls off the radar of mainstream investors. This apathy is precisely what creates opportunity. Few portfolios today have meaningful exposure to silver. Institutional allocations are minimal and public interest is low. But history shows that market sentiment is cyclical too. When performance reverses, attention follows and flows of capital accelerate the trend. In other words, undervaluation is both a financial and psychological condition, and both tend to correct powerfully. From a structural point of view, silver's dual identity as both a precious and industrial metal strengthens its long-term case. On one hand, it benefits from the same forces that drive gold: inflation, monetary expansion, and loss of currency trust. On the other, it gains from global industrial trends like electrification, clean energy, and technology growth. The world is moving towards sustainability, and silver is a critical component in solar panels, batteries, and electronics. This creates a situation where monetary demand and industrial demand converge, amplifying price potential once the revaluation begins. To interpret this rationally, we should think in terms of probabilities, not predictions. Nobody can know the exact month or year when silver will surge, but history provides a clear pattern. When real interest rates turn negative, when money printing accelerates, and when debt ratios explode, silver enters a long-term uptrend. These are not opinions. They are outcomes rooted in data across decades. The present environment fits that pattern almost perfectly. Long-term cycles are slow to build, but fast to unwind. They're like tectonic plates, stable until friction forces a sudden release. Silver's current price levels are the calm before that release. The factors aligning: debt saturation, underinvestment in mining, industrial expansion, and monetary devaluation all point in the same direction. The only unknown is timing. Smart investors don't wait for confirmation because confirmation comes after prices move. They prepare when the data tells them an imbalance is unsustainable. The undervaluation of silver, then, is not a temporary anomaly. It's a reflection of where we are in the broader monetary and debt cycle. When economies rely on debt and printed money to sustain growth, currencies lose credibility and real assets gain it. This shift is cyclical, inevitable, and already underway beneath the surface. History shows that those who recognize these turning points early build wealth, not by chasing momentum, but by understanding rhythm, the rhythm of how economies expand and contract, how confidence inflates and deflates, and how value redistributes over time. Silver's undervaluation today is the silence before the storm, the phase where the patient observer quietly accumulates while the crowd dismisses it as irrelevant. But as every past cycle has taught, when the pendulum swings back, it moves faster and further than most expect. And when it does, those who understood the deeper pattern of cause and effect will find themselves not surprised by the explosion ahead, but prepared for it. Smart investors understand that success in markets is not about prediction, it's about preparation. Prediction implies certainty about the future, but the future is inherently uncertain. Preparation, on the other hand, is built on probabilities, patterns, and principles that hold true across time. The best investors don't try to guess what will happen next week or next month. Instead, they study cause and effect relationships, how one variable leads to another, and they position themselves so that no matter which path reality takes, they are protected or well placed to benefit. This mindset requires humility, discipline, and a deep respect for history. The markets are essentially reflections of human behavior, and human behavior follows consistent patterns. Fear leads to selling, optimism leads to buying, and both tend to overshoot reality. Smart investors don't get caught in that emotional loop. They watch the same data everyone else does, but they interpret it through a framework, one grounded in cycles, fundamentals, and probability. In the context of silver and the coming financial environment, preparation means understanding what drives change. It means looking beyond headlines about price movements and identifying the forces beneath them, the growth of debt, the persistence of inflation, the weakening of currency credibility, and the emergence of technological demand. Each of these forces interacts with the others in predictable ways. Debt expansion creates the need for monetary easing. Monetary easing reduces the value of fiat money. Reduced currency trust pushes investors toward tangible assets. When these forces align, a shift occurs, and those who have studied history are already prepared for it. Most investors act reactively because the system conditions them to. The news cycle, social media, and even financial institutions focus on immediate trends, not on long-term patterns. This creates noise, and noise is the enemy of preparation. Smart investors filter noise by focusing on timeless principles. They ask, what are the drivers of value? How do these drivers behave under different monetary conditions? And what is the probability distribution of outcomes? This method turns uncertainty from a source of fear into a tool for opportunity. Preparation, in this sense, is not just financial, it's psychological. It's the ability to remain calm when markets panic and cautious when others are euphoric. History shows that the biggest profits are made during times of maximum pessimism, because that's when assets are most undervalued. But acting during those times requires emotional balance. The average investor waits for reassurance. They want the crowd to validate their decision. The smart investor acts when logic and evidence align, even if sentiment doesn't. That's what it means to prepare, not predict. To prepare effectively, one must also study how cycles interact. There are short-term debt cycles that last about 5 to 10 years and long-term debt cycles that can stretch 50 to 75 years. The short-term cycles are business cycles, expansions, and recessions. The long-term cycles are structural, the rise and fall of monetary systems. We are currently nearing the end of one such long-term cycle characterized by excessive debt, monetary debasement, and the erosion of trust in fiat currencies. Smart investors recognize this pattern because it has happened before in every major empire and financial system throughout history. Preparation, therefore, involves aligning one's portfolio with reality rather than sentiment. It means holding a diversified set of assets that perform under different conditions. In Ray Dalio's language, this is called the holy grail of investing, a portfolio that balances risk and opportunity across environments. Within such a portfolio, assets like silver play a critical role. They are not just speculative tools, but strategic hedges against monetary instability. When fiat money weakens, hard assets strengthen. This is not opinion. It's a repeating pattern observable in data across centuries. Many investors make the mistake of thinking that preparation is about timing. They want to know the exact moment when prices will rise. But preparation is about positioning, not prediction. Timing is almost impossible to get right consistently because it depends on short-term market sentiment. Positioning, on the other hand, is based on understanding asymmetry, situations where the potential upside significantly outweighs the downside. Silver today represents one such asymmetrical opportunity. It is undervalued relative to history, ignored by the mainstream, yet supported by structural tailwinds. Preparing for its revaluation means building exposure gradually and patiently, not chasing headlines. Another principle that separates the prepared investor from the reactive one is the study of history. History doesn't repeat exactly, but it rhymes. The events change, but the dynamics, the cause, and effect sequences remain constant. If you study the periods before major shifts, whether the Great Depression, the 1970s stagflation, or the 2008 crisis, you find similar setups: rising debt burdens, monetary intervention, declining real yields, and growing inequality. Each of these environments eventually led to a loss of faith in paper money and a surge in real asset values. Silver, being both precious and industrial, tends to outperform during these phases because it bridges two worlds: monetary protection and industrial necessity. Preparation also involves mental flexibility. The best investors are not rigid thinkers. They don't cling to one belief or forecast. They update their understanding as new information arrives. This adaptability allows them to navigate changing environments without panic. They think in scenarios: if inflation persists, how does silver behave? If growth slows but monetary easing resumes, what happens? If geopolitical risk rises, how do investors reprice safety assets? By modeling these cause and effect relationships, they prepare for multiple outcomes rather than betting on a single one. In practical terms, preparation requires balance. It's not about going all in on any one asset, but about maintaining strategic exposure to different sources of return. Silver's role, in particular, is to protect purchasing power when fiat systems are under pressure. Smart investors accumulate it during periods of neglect, not during excitement. They understand that wealth is built during quiet times, not during market hysteria. When everyone else starts to notice the opportunity, the easy part of the gain is usually over. The philosophical foundation of this approach is humility. No one knows the future with certainty. But by studying history, cause and effect, and the mechanics of markets, one can know the probabilities. And probability, when applied with discipline, becomes a form of power. Preparation allows you to move with the tide rather than against it. It's like sailing. You can't control the wind, but you can adjust your sails to capture it. Smart investors don't wait for certainty. They wait for clarity, and clarity comes not from emotion, but from understanding how things work. Once you see the relationships between money, creation, debt accumulation, inflation, and asset revaluation, the path forward becomes obvious even if timing remains uncertain. At that point, preparation becomes a matter of discipline: build positions patiently, manage risk intelligently, and stay emotionally neutral. When the next major cycle unfolds, as debt peaks, money loses value, and confidence shifts, those who prepared will not be surprised. They will see the events as the logical outcome of the patterns they study. The difference between those who predict and those who prepare is that predictors chase moments, while preparers understand movements. Predictors try to time explosions. Preparers quietly build shelters before they arrive. The world ahead, especially as we move deeper into 2025, will test investors' patience and understanding. Silver's revaluation may come suddenly, but its foundation has been building for years. Smart investors are already adjusting, not because they know exactly what will happen, but because they understand why things happen. That understanding is the ultimate edge. Preparation is the discipline of aligning with truth before it becomes obvious to everyone else. And when it finally does, those who were prepared won't just have profits, they'll have peace of mind. The coming explosion in silver is not just a price movement or a market trade. It is a reflection of something far deeper, a structural shift in the global financial system. Every time throughout history that societies have expanded debt beyond sustainable levels, devalued their currencies to manage that debt, and lost collective confidence in paper money, the world has returned to real assets as the foundation of value. This process is not theoretical. It has been observed in every major economic era. Silver, along with gold and other tangible assets, has always been a beneficiary of this return to reality because it represents something that cannot be printed, manipulated, or inflated away by policy decisions. To understand what's coming, we must look at how the system operates today. Global debt levels have reached historic highs, exceeding a 300 trillion worldwide. Governments, corporations, and individuals are all heavily leveraged. The debt burden is so large that even small increases in interest rates create significant strain. This is why central banks, despite their public commitment to controlling inflation, remain trapped. If they raise rates too much, they trigger defaults, recessions, and market collapses. If they lower rates or inject liquidity again, they weaken currencies and reignite inflation. Either path undermines confidence in the system, and both lead investors to re-evaluate what value truly means. The mechanics behind this are simple but powerful. Money is created through debt. When central banks lower rates, more money flows into the economy through borrowing. Over time, this leads to more spending, which raises asset prices, but it also increases total debt. Eventually, the cost of servicing that debt becomes too high, and central banks are forced to intervene by printing even more money or buying back government bonds to suppress interest rates. This cycle, expansion, leverage, inflation, intervention, continues until the system reaches a breaking point where currency debasement becomes visible. At that moment, trust begins to erode, and people instinctively seek assets that exist outside the debt system. That is when silver and gold experience explosive revaluations. We are now entering that phase. The signs are visible everywhere. Inflation remains persistent despite rate hikes, fiscal deficits are widening, and geopolitical tensions are disrupting supply chains. These are not isolated issues. They are interconnected symptoms of a deeper imbalance. The global economy has become dependent on debt to function, and when debt becomes the main engine of growth, the system can no longer self-correct. It must reset. Historically, resets have always involved a revaluation of real assets relative to paper ones. Silver stands out in this environment because it sits at the intersection of monetary and industrial value. Its role in technology and green energy gives it intrinsic demand that's less sensitive to financial speculation, while its limited supply and historical monetary role give it protection against currency erosion. When the financial system weakens, capital naturally flows into real assets. But when those assets also serve industrial and technological needs, the demand multiplies. That is the kind of alignment we are witnessing with silver today. To put this in perspective, consider the last major systemic shifts in history. After World War II, the world transitioned to a dollar-based system backed by gold under the Bretton Woods Agreement. When that system became unsustainable due to excessive U.S. spending and debt accumulation, President Nixon closed the gold window in 1971, effectively detaching the dollar from gold. What follows was a massive devaluation of currency and a surge in the prices of tangible assets. Silver rose from 1.50 to nearly $50 within a decade. The same forces that drove that move are now emerging only on a larger, more global scale. The digital age has added complexity, but it hasn't changed the underlying mechanics. Governments can now expand the money supply faster than ever, and markets react instantly. But the fundamental law remains: when the supply of money outpaces the creation of real wealth, inflation is inevitable. It may appear first in asset prices, housing, stocks, or bonds, before showing up in consumer goods, but eventually it surfaces everywhere. Once that happens, people look for assets that cannot be printed or defaulted on. Silver, by its nature, fits that role perfectly. The idea of an explosion in silver is therefore not about speculation. It's about equilibrium. Prices of all assets eventually revert to their real inflation-adjusted value. When financial systems suppress natural market forces through artificial interest rates, quantitative easing, and fiscal stimulus, they create distortions. Those distortions accumulate until they can no longer be maintained, and then the correction happens rapidly. Silver's current price relative to global debt, fiat currency supply, and monetary base is among the lowest in modern history. When correction comes, it will be an adjustment to reality, not a bubble. Smart investors understand this by observing not just price charts, but structural indicators. Central banks, for example, are accumulating gold at the fastest pace in decades. This signals that even institutions responsible for printing money are preparing for currency risk. Meanwhile, silver inventories in major exchanges are declining and production growth remains stagnant. These are factual data points, not opinions. They point toward a tightening market where demand will eventually overwhelm available supply. When that happens, prices won't rise gradually. They will reset abruptly as the market reprices what silver is truly worth in a world of depreciating paper assets. The broader story here is one of systemic balance and imbalance. Systems always seek equilibrium, but when manipulated for too long, they overcorrect. The debt-based financial model has extended far beyond its natural limits. Debt growth has outpaced income, financial assets have outpaced productivity, and monetary expansion has outpaced real output. That imbalance cannot persist indefinitely. A rebalancing is inevitable, and real assets, tangible, finite, and trusted, become the new anchors during that process. Silver's historical role reinforces this. In times of stability, it is overlooked. In times of transition, it becomes essential. Every major monetary reorganization, from the collapse of the Roman denarius to the Great Depression to the end of Bretton Woods, has been accompanied by a surge in the value of tangible stores of wealth. This is not coincidence, it's cause and effect. Paper systems fail when overextended. Real assets regain prominence when trust in paper fades. The explosion ahead in silver is, therefore, not a random market spike, but a reflection of deeper structural adjustments, a mirror held up to a system that has stretched itself too far. It represents a transfer of value from inflated paper promises to tangible reality. When debt becomes too large to repay, societies don't default outright. They default silently through inflation. The purchasing power of money declines, and the prices of real things, metals, commodities, land, rise to compensate. For thoughtful investors, the lesson is not about chasing the next rally. It's about understanding the underlying mechanics of change. Silver's surge will be a symptom, not a cause. The cause is the unsustainable structure of global debt and monetary expansion. Recognizing that pattern allows investors to prepare, not panic. When this rebalancing unfolds, those who own real assets will not just preserve wealth. They will hold the foundation upon which the next financial system is built. Every cycle in history has led back to that point, when illusions fade and real value is rediscovered. Silver, as it has done for thousands of years, will once again remind the world that true wealth is not what can be printed, but what endures. As we stand at this turning point in history, we must remember that every great transformation comes with both risk and opportunity. The world is entering a new era, one defined not by comfort, but by challenge, not by illusion, but by truth. Debt cycles are peaking, currencies are weakening, and systems that once felt unshakable are beginning to tremble. Yet within this uncertainty lies the foundation of renewal, because every collapse of the old gives rise to something stronger, more balanced, and more real. The lesson of history is not to fear these transitions, but to understand them. When nations expand debt beyond their means, when money is printed faster than productivity grows, and when speculation replaces hard work, decline follows. But those who recognize the signals early, those who study cycles rather than headlines, are the ones who adapt, survive, and ultimately thrive. They don't see chaos, they see correction. They don't chase illusions, they position for reality. This is not just about markets or metals, it's about mindset. The difference between panic and preparation is perspective. When you understand the mechanics of how economies rise and fall, you stop reacting emotionally and start acting intelligently. You begin to see that every storm, no matter how severe, clears the path for new growth. And that growth belongs to those who had the courage to prepare while others ignored the signs. The world is now witnessing the slow unwinding of an unsustainable era, an age built on credit expansion, artificial rates, and monetary manipulation. This system cannot continue indefinitely because nature itself demands balance. You can delay the reckoning, but you cannot cancel it. And when it comes, value returns to where it has always belonged, in real assets, real productivity, and real trust. That's why understanding assets like silver and gold is not just an investment strategy. It's a study of economic truth. But the deeper message is about more than finance. It's about how individuals and nations respond to change. In times of abundance, discipline fades. In times of correction, discipline returns. History shows us that adversity rebuilds integrity, that pain brings clarity, and that humility is often the first step toward wisdom. What seems like loss in the short term often becomes strength in the long term. And those who accept that truth rise from every crisis with greater resilience than before. Each of us has a choice to follow the crowd into denial or to step aside and prepare. Preparation does not mean fear. It means awareness. It means diversifying not only your assets, but also your thinking. It means developing the patience to see beyond short-term noise and the conviction to act on logic when others act on emotion. Because wealth, in its truest form, is not about possession. It's about perception. It's the ability to see value before the world does. Throughout history, the greatest fortunes have been built not in times of calm, but in times of change. Those who understood the turning points, who saw debt cycles for what they were, emerged from them not just wealthier, but wiser. They built new systems, new institutions, and new rules for a more balanced world. And that's the opportunity before us now. The coming shift is not an end, it's a beginning. It's a reset that will test the strength of our principles and the clarity of our understanding. So, as this cycle turns, let it remind us of something timeless. Money may be created by governments, but value is created by trust. Trust in real assets, trust in productivity, trust in human potential. When systems break down, that trust becomes the world's most valuable currency. And the people who hold it, those who stay informed, disciplined, and grounded, will shape the next era of prosperity. The explosion ahead, whether in silver or in broader markets, is not a signal of destruction. It is a signal of truth reasserting itself. It is the economy's way of reminding us that reality cannot be postponed forever. And when that reality returns, it rewards those who respected it all along. We are entering a decade that will redefine what wealth, security, and value truly mean. But if history has taught us anything, it's that those who adapt early, who anchor themselves in principles rather than predictions, always come out stronger. Because real success doesn't come from chasing trends. It comes from understanding the timeless patterns that govern them. So as you move forward, remember cycles end, but wisdom endures. Paper fades, but principles don't. In every great transition, the most valuable asset you can own is knowledge. Knowledge of how the world really works, how value is created, and how to align yourself with it. That understanding is the ultimate protection and the ultimate opportunity. In the end, this is not just a speech about silver or markets. It's a message about clarity, discipline, and truth. The same truths that have guided civilizations through centuries of expansion and collapse. The same truths that remind us that wealth is not built in the noise of speculation, but in the silence of understanding. So when the world around you seems uncertain, don't fear it. Study it. Don't chase the rush of the crowd. Follow the rhythm of reality, because in the long arc of history, those who understand cycles don't just survive them, they master them. And mastery, in every age, belongs to those who see beyond the surface and recognize that the future always rewards the prepared mind.